All right, we're going to get started in about 30 seconds. Okay, I guess let's just get into it. So this webinar is brought to you by the Riverside family of companies as well as G-Parency. Riverside is primarily led by Riverside Abstract. It's a premier real estate service company providing unmatched service and offerings in every stage of a real estate transaction. Riverside is a leader in title insurance, 1031 exchanges, cost segregation studies, and entity formations and filings. So along with the underwriting and educational expertise of the Riverside experience, these are some of the ways that Riverside is looking to help you navigate the ins and outs of all your real estate transactions. And we hope to, outside of this webinar, we hope to work together with you in the future. I guess, Ira, we're going to talk a lot about G-Parency throughout this discussion. And before we get into the interesting time that we're in the market, can you give us a little bit of background about who you are and tell us a little bit about your career journey and how it led you to create G-Parency?
So thank you very much for hosting. I hope it's a benefit to everyone that's joining. I think it's really an apropos time. Couldn't have your foresight and the timing could not have been more perfect based on everything that's going on. So for the long and short, I've been doing the same thing for my whole career. I'm a trusted advisor in the commercial real estate finance space. Up until about 2 years ago, my full day was consumed as a conventional mortgage broker. We're advising clients when they need financing, and they pay successfully when the deal closed. I've noticed that the world is changing, technology is changing, people are more empowered. It's not as opaque this world as it used to be. People have, I feel like everyone today works for LinkedIn and everyone knows what's going on. I was on all these real estate chats, and I saw the market heading in a direction where people want to be more in control. Not every time do they want to have a one, take it or leave it, use a broker and pay a certain way. Sometimes they want to go themselves. Sometimes they want you help them go direct. Sometimes they want the assistance, but they'd rather pay for the time, and sometimes successfully. So I saw the market changing. As the saying goes, you can't build Netflix while you're a Blockbuster. I got offered a venture capital offer to build the largest seed round for prop tech or fintech in the space, whatever the terminology you call it. And I took the leap of faith. Today's actually two-year anniversary, exactly to the day. It's November 15th, 21. And it's really being empowering. Parents is called GP, the general partner, the investor, the real estate syndicator, the buyer. Transparency, providing full transparency. And today we have a full suite of products. For those that want to use a broker, we have success fee paid at closing, capped at 0.5 point and 100,000. Someone wants to do a deal, say, I want to pay up front, have someone place it for me. I'll take over myself, like assist me going direct, $4,500, or use our technology and be able to do the deal totally yourself. So staying the same thing, always looking to provide value for the commercial real estate owner, and continuing that in that space. And here we
are. So we're definitely in a. I can only say I've been in the business for for over a decade, and this is probably the most unusual period that I've experienced in the market. So can you give us a brief overview of where we are in the market, and then we're going to talk about some of the challenges and some of the opportunities that that people can potentially face or capitalize on.
Yeah, when you say where we are in the market, like that's a very broad, like narrow down a little bit. So it's, how would you like narrow down that, when you say where we are in the market and from which perspective?
And before we talk, and we're going to talk about like debt, the debt world, but let's just talk about like market cycles. Like we've seen cap rates go down for a bunch of years, and then we've seen interest rates go up. So I guess big picture, if you're going to jump if you want to give a reading of the commercial real estate market, how would you describe what you're seeing right now?
So like I said in a recent video, I said I think that we're 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 at the bottom. It's been like this a little bit for a while, but I think that um, there's very few transactions compared to, obviously there's a lot of transactions if you look at that, but compared to where it's coming from, it's a drastic slowdown. I think that right now, with the final straw being Signature Bank finally selling their notes, now buyers are going to come out there. They close out the bidding. I think that people at this point are going to start throwing in the towel, and we're going to realize what the price of real estate really is. And at that reset is going to allow people to hit really rock bottom in that sense and say, like Warren Buffett says, real estate's forever. The owners may change. And I think now we're going to start seeing some changing the guards. People throwing in the towel, and the new view of how to buy real estate and underwrite real estate is going to start kicking in right now. And that's why I personally think this is the best time to come to commercial real estate. Like if you ever think about changing a part of your career, this is the time, because at this moment you don't have old baggage if you're new. You're coming into this market, you're seeing the world from where it is right now, and things should only over the next few months settle out, and then from that point start getting a lot better. So I think that the real root, though, people say, what's the root? What changed? What changed is that real estate, when I came into the business, was about bricks and mortar. You spoke to people, they didn't have the type of underwriting, the service that you provide didn't exist 20 years ago. There's no company really did it. And today, not only do you, in this market, you need a service like you provide even more, because it's all about financial engineering. It happens to be it's backed by a piece of real estate, just like it'd be backed by a business, it's backed by other industries. And you have to understand financial engineering. So when someone buys a piece of real estate, it used to be, hey, how much am I paying per door? How much am I paying per square foot? What's the replacement value? Those are the main questions, the main conversations. Now it's all about NOI. And if I get, I get this dollar up, this dollar down, I could get more proceeds. How do you make the projections? What should work? But with that same dynamic, what's changing also is the investors. They're seeing certain losses. They're pulling back. They could put money in the bank at 6%. When people start investing heavy in real estate was going up, and the money in the bank was making them zero. So the dynamic of financial engineering caused that deals just don't make sense if rates are up and in markets where rents aren't moving up anymore and inflation keeps moving up. These become issues right now. So today we're in that mindset that what when we're speaking to different lenders and big owners and developers and equity funds, they felt the market really should have corrected itself a couple of months ago. But people are so scarred from 2008, where they say there's a once in a lifetime, once in a generational opportunity is going to come up, which I believe is true. You just can't catch a falling knife. You don't know exactly when. So many owners stay on and held on to their properties longer than they should have, because they don't want to be the one, hey, I'm going to give it up. The rates are going to drop and they lose the money. So they kept pushing it off. But I think today we're coming to the point where they're just exhausted. They're realizing, hey, I'm never going to make my promotes. Rates aren't going down. If they go down, it's a half a point down. They're thinking, no, the perception is not going to go down to where it used to be. And I think at this point, banks are going to start writing off paper losses this year and selling the papers at a discount next year. You see the signature nodes, you see different changes on the agencies, how they're going to change underwriting. You put all these things together, and people say, hey, it's not what it used to be. You can't buy a building and cash up. I'll end with one thing on this point, is that when I came into the business, someone bought a building for $1 million. They took out a mortgage for $750,000. They worked the tail off for 5 years. 5 years later, the building's worth $1.2 million. They refinanced it. They got 900,000, 150 of their initial equity. Then they bought another building. Today, for the last couple of years, the mindset was, let me buy a deal, value add, hopefully within 2 years, get all my money out, and then some, and they keep moving. We're definitely going back to the older ways also. So if you're investing in a deal, it's a long and steady, slow and steady growth, as opposed to what it was the last few years. So that's a broad answer in the cycle. But I think that the opportunities are going to open for a lot of people. You're going to see a lot of movement in the real estate community of people moving in and out of different companies and taking more specific roles.
Right, because like let's say in 2020, we saw cap rates that were trading for in the threes. Three caps wasn't uncommon to see. And now that the interest rates have moved up, it's cap rates have the interest rates in 2020 at one point were under 3%. You remember seeing those interest rates, right? And now interest rates seem to be over 6, probably 6.5 around last couple months. So in your career, do you remember seeing a time where there has been that drastic of a shift in interest rates?
So I'm not. I'm sure there's been different spikes. I don't think that, but the difference now is twofold. Number one is that you're talking about double to triple, and also it's in a world when we're all about financial engineering. So cap rates have to trade at higher than the debt, and with amortization even higher. So that's a big difference. Values are directly related, but I think the big difference is that even when it did spike up in the past, it actually just spiked up and came back down. That's what people thought do the same thing here. It seems to be this is it, staying here. So it went up. Like I was talking to a real estate owner, tells me, I remember interest rates at 12%. It's not so bad, By telling me, yeah, but you remember going from 18 to 12. You don't remember going from 3 to 6 to 7, and God forbid if it keeps moving up from this point. So it's a different, you have to go to a different perspective and different how people bought real estate. I use the analogy for your car. How much is your car worth? Let's say you think your car is $30,000, $50,000, $100,000, what are the prices? Oh, interest rates went up yesterday. Did it change the value of your car? No. Real estate. Oh, rates went up. Oh, the real estate went down now. It's not even about real estate, it's about financials. So as these rates go up, everything is changing accordingly because of. So so it definitely has more ramifications today than it ever did, even if there was a spike up in the past. Today it has a more meaningful spike up than it did in the past.
And it doesn't seem so. There definitely is. It has impacted the pricing. It's definitely impacted pricing of real estate. But what I'm seeing on our end, we're in the title business. So we definitely have seen, I think everybody's seen a slowdown in transactions. At what point do you think people will know, in your opinion, because this is all just based on opinion, when the right time to start, to really become active again? Because you said, you mentioned before, it's like catching a falling knife. At what point do you think things will stabilize and that people will be comfortable to start transacting?
So I have 2 points on that. And again, this is from just speaking to a lot of real estate owners and people that are much smarter than I am, that live through more cycles than I lived through. The first thing is, if a deal right now makes sense today, like if someone who's actively always buying, I buy X number of deals a year. There's a thought process. If a deal makes sense today, and based on you can lock in long-term rates, and it works for the current view of the world, why not buy a deal today? That's someone who's active, someone who's waiting for the opportunity. I think that I hear from the smartest advice, because now that you can't catch a falling knife, you can't time a market. So everyone's dream is on the V is to buy at the bottom over here. I had from the smartest real estate players and investors that I know, it tells me I never buy at the bottom. I don't even attempt to. I buy after the bottom when I hear it starts going up, and for a couple of months, and it doesn't like dead cat, they took a dead cat jump or something like that, where it goes and then comes back down, then I buy. I'd rather miss the first inning and make it from the second inning and on. Look at how many people we know just started in the real estate business 2012, 13, 14. They didn't start 2009 when it started opening to that. They missed the first, was still fine. And that's it. But I think that is coming at the end of the first quarter, beginning of the second quarter. Are there going to be isolated cases where someone has to get out tomorrow morning, they're going to sell at a great price end of the year? Without a doubt. Someone has an issue that's unrelated to that. But I think that for the majority, the 80%, leave aside the 10%, the 10%, the 80%, I think at the end of the first quarter, beginning of the second quarter, there's going to be serious opportunities that are going to come in. What I don't know yet is how easy it's going to be to raise equity again for the new investors. Because the new investors they're making 5% in the bank. The money's liquid. So in order to be in their boat, they might say, hey, I want, that might cause a low valuation again. But I think the way from all the feedback, it looks like at the end of the first quarter, beginning of the second quarter is when it will start. We'll be in that first inning in the right place. And then the question is, how long do you want to give it before you say, oh, this is cemented? I want 2 months, 3 months, 4 months behind me before I want 2, 3, 4 innings before I make the jump in from there.
Okay, so now I want to talk about one of the before we get into the technology, the last couple weeks have been very interesting. For anybody who hasn't been following, a lot of the deals that get done, especially in the last couple of years, if you're a typical multifamily deal, if you have a deal that's done correctly and it checks, it's not in a transitional state, everybody wants to go to one of the agency lenders for the most part, because it's probably going to be your best pricing. Obviously, it has to check a lot of boxes in terms of the property, the borrower. But if your property checks out, you want to take it to I don't know if you would agree, but for the most part, your best terms will come from one of the agency lenders.
I think it's a blend of the longest fixed rate and interest only. A lot of flexibilities, and probably because of the amortization interest only, you could probably also get the maximum proceeds compared to the market. So I think it has those perks.
Right, and you also like you don't have to be in the good graces of a 75-year-old guy that on a golf course that's made that from a loan committee, right? If your property checks box.
I don't know if you've seen bankers recently, but there's bankers in their 30s. You know what I'm saying? It's not just
Right. But the point is, it has to if it checks boxes, right? Versus
it's more again, financial engineering, more transactional. In order the agencies, Fannie Mae and Freddie Mac, to do what they're doing, they have to be more about a process and procedure that works to make sense.
right. Their whole mandate is to provide liquidity for housing in the country.
Right.
They're there to provide housing. So the last couple of weeks have been very interesting. So why don't can you give us an overview of what happened? We don't have to talk in specifics. I think as the industry as a whole, what happened? Where are we right now, and where do you see this playing out?
So, like I said before, what makes the benefit and the negative to a agency loan is that they don't get emotional into the one person. They have their way of doing business, has to check boxes. They're a duopoly. No one really understands why they need two. It's really a government agency, but they really operate as to compete against each other to a certain extent. I'm sure in the mandate somewhere, someone could actually understand the difference of what they do and why they do, but that's the way they set themselves up. What I found with them is that what happened is that as clearly as you're watching the news, rates are going up and cap rates are changing, and there's definitely certain losses being taken across the industry. They want to protect and say, hey, maybe the underwriting that was done in the past, we have to start taking a look at the underwriting. We have to start saying is what should we change any procedures and processes in the underwriting. So while they're taking a look at this thing that's going on, the biggest change that they made was that they basically came out and said, listen, the way Freddie Mac and Fannie Mae works is that think about it as a wholesaler. Sometimes the best idea is think about it as a car dealership. You want to buy yourself a Lexus tomorrow. You don't call up Lexus. You can't call up the mothership Lexus. You call up one of their actually not better than a car dealership, a watch company. Okay, you want to buy a Rolex, you're not picking up the phone and calling up Rolex. You got to go to one of their registered resellers or dealers. Same thing concept works here. You can't go to Fannie Mae and Freddie Mac direct. There are about 28 shops. I'm actually putting out a list on Transparency now they want to push for the direct, putting out a list of all the shops and who the people the shops are, so people could see a list of the total between the two shops, who they're authorized resellers, for lack of a better term. And what they said, Freddie Mac and Fannie Mae came out and said, listen here, it's fine if you want to use mortgage brokers, no problem. But if you do, the first changes they're making in this market is that there's going to be a pre-review. Every deal that comes in from that broker is going to get extra scrutiny. Every deal that comes in from that broker is going to get, even if you, aside from the scrutiny, is that when they ask certain questions on documentation, the documentation has to come straight from the borrower, as opposed to going through the broker. So this change, literally, I don't know, it's last week. This is not going on for a long time. It's just like hit the market. Is everyone's really like dealing with it? How is this going to change the way that many people use brokers? This is what they use a broker for. They tell a broker, here, you have my deal. This is what I'm looking to borrow. And the broker deal with it and just come back to me at the closing table or tell me what I need along the way, and I'll fill that information. So that was the change that came out last week. And the question is this just the beginning of what? As somebody posted a chat on there, that agencies, Fannie and Freddie, only lend on apartments. Like Mark said before, they're here to provide liquidity for homes. So if you think about it in the simplest form to everyone, depending who's new on the experience on this webinar, think about your home. Think about your money that you have. You open up a bank account. Where do you put the money in the bank account? It's a savings account. You put it into a CD. 5-year CD is the longest. How can you borrow money on your house if you took out a mortgage a few years ago for 3%, 30-year fixed? What's that mechanism that allows it to be there? That's through Fannie and Freddie buys the paper. and they, however, the mechanism of bond, whatever they do, implied guarantees in the government. That same thing they do for homes, they also want to apply for multifamily, all different type of housing. And that's, so this is this change that they made, and they're the biggest lender today. This change that they made is a change that's saying is, hey, you could deal with brokers, but we're going to take it, we're going to have a different level of due diligence when a deal comes through a broker. The question is the next step of this going to be that they're also having underwriting changes in general in how they underwrite deals and how they look at deals in general in this new market? If that is the case, then going back to what we said before, financial engineering is what makes a deal happen. So when real estate prices went through the roof, was not only as rates went down and banks provided more leverage, so people had more cash flow, they could afford to pay more. If they can have stricter underwriting in general, or anyone changes underwriting, that will also cause a level of valuation. So talking about, is this the right time in the market? I think all these things, signature note, the Fannie Mae changes, all these things, bank taking right down, paper losses, all these things are going to come to a head. That we start the first quarter, second quarter, we'll know the dust will settle. This is the new world, and people, the sellers will start selling and say, hey, this is the new world. I thought it was going to come back. It's not. Let me see what I want to do.
Yeah, interesting. It's a very interesting time. Now, do you think that because this is not, it seems like they're trying to pin the blame on brokers, but I've been in the business for a while, and it's not it's not something that a broker's doing, not financially engineering it. The way that it works in the industry is
I want to just interject very important. The word financial engineering is not a code word for anything bad. Financial engineering, they're saying like to blame brokers. There's no innuendo on the word financial. Financial engineering means simply that when a person, but there's nothing to do with this week. When somebody has you have $1 million to invest, you're looking for the maximum return. So when I first did my first deal, I still remember early on in my career, I financed a building in Maryland with a Wall Street shop, and in that market, the buildings were selling for $25,000 or $26,000 per door. And when the bank underwrote it, they didn't look at per door. They looked at it and said, hey, you're buying this building, you have this much cash flow, people would love to make that kind of return. They're willing to pay $30,000 a door. And they lent this person based on a much higher valuation. That's called financial engineering. There's no games that are played, no innuendo games. So I just want to separate that. If you want to say why they're putting this on the brokers, don't tie it to the word financial engineering. That's a fact of the industry on the most positive end of it. We're driven by financial engineering.
Yeah. So the question is, do you think that they're trying to avoid blame and then pinning it on brokers? Because the way that I've seen every deal work is, I'll give you an example. If you had payroll, let's say somebody you were buying a property from somebody that was operating their payroll at a very high number, because whatever, maybe they just weren't as efficient. They made money on the deal, and they're not operating it as efficiently as possible. You don't need to spend, let's say, $500,000 for the payroll for 6 people in that market. You could spend 300,000. So the point was that you would know that this is the level that one of the agencies is comfortable at. So do you think that those? I guess the question is, do you think that this broker business it's being pinned on brokers as like kind of to get to some of the decision makers at these agencies don't want the blame to fall on them? Or do you think that do you understand the question?
I understand the question, but I want to really, again, avoid on a level of innuendo, but I'll answer your question a few different points. I think that from the beginning of time, there's been this love-hate relationship between lenders and brokers. And a lot of times they can't really be honest what they feel. My dad, in blessed memory, always told me my whole life is that when you go into business, you want to follow where the wind is blowing. Try never to get a no. Ask enough questions. Don't make a pitch if the person's not going to move forward. I want to name transparency as transparency, is because if I want to try to, I tell people I only have one edge over almost anyone on this planet. The only edge I have because of experience is that my whole career, I only made money when I closed a deal. So I didn't take money up front. So I didn't, and I had to hire people. Should I hire this person? They have to build a business long enough, cover the expenses of them. Are they going to be successful until it closes? So I spent a lot of time to say where the wind is blowing. And as anyone who knows me, and I was very vocal about this, is that clearly there's a trend to people using brokers less. That what's the value to a broker? Sometimes there is, sometimes it's not. And there is a broker. How much should I pay that broker? There's always those questions at different times people came up. And it's not a debate here for that point. But I realized talking to banks, the higher up I went into the food chain, talking to lenders and Fannie and Freddie and everybody, they didn't really like brokers because their view, why do you exist? You're just another expense along the chain from the lender side of it. And that's just the mode. So before anything, they could snap their fingers, but where's the love? There's a value. They bring them deal flow, right? They create a competition. They bring them deal flow. So in a holistic view, they didn't love them. What's happening over here is that there's clearly losses that are taking place. And you brought up a very good example. When it comes to underwriting, it's about this transparency, full disclosure. They want to make sure that they know that that extra $500 is the actual expense you spent money on. And then you're buying a building or the seller spent that money on, and you're explaining it and saying, hey, there is 500, but I think I'm able to do it for 300. There's the reason. What a bank wants from me, when I came to a bank and said, what do you want from me? The bank says, I want honest representation. Tell me what you know. You're human. We're human. We can make mistakes. Tell me everything you know and let me make the credit decision. And that's what we're looking for. So over here, what they're basically saying is the first thing we want to do is make sure that our lenders know all the information. I don't want to take a chance that there could be an honest mistake in the process. And I want to make sure that I'm getting something straight from the seller who's going to tell me this is the information, using your example, $500,000, but I think I do for $350,000. As opposed to sometimes if there's a mistake, an honest mistake, it's the same 350, but they're not explaining that it came down from 500 and this was the reason it came down. So before the passing blame, I don't think about the blame per se. It's just the starting point is let's make sure we're doing business. We already have a buffer between us. Let's make sure in the agencies have their dust shops. Let's have a borrower directly come to this information and let's verify the information directly. So this, by virtue of it, doesn't mean it's a knock to the brokers, because the reality is some owners are going to say, hey, why do I want this extra scrutiny for what? Right? I took some big real things, why do I want this extra scrutiny? And, I could bring it out. On the other end of it, if you're sitting in a sidecar, what's the benefit of the brokerage community? There's a certain mystique, and a positive mystique and an aura that they know the business, they'll make things happen, they'll get things done. And in a positive light, because there's always bad apples everywhere you go. Let's go with the 99.9% of an industry. They're good people. So in that process, they give them a broker to deal. But if on every single transaction, you're sitting in the sidecar and you're involved talking to the lender, then after a while, like, what's that same value that you bring into the table? Where does that go to? And how does that industry change? And that's what the fear now is that the value that the brokers bring in general is just keeping in touch with all the lenders. You don't know, maybe, like you said before, is Fannie Mae a good option for people? Is Freddie Mac a good option? What about for that specific deal? It's not a good option. It's better to go to this bank. That's the real value. The real value, when I came into this business, the main value a broker brought to the table was, number one, creating the competition, and number two, making the right introductions. That was the main value of a broker. And today, the brokers get involved throughout the whole entire process. So there's other values, but that was the starting point value of where it came into the business. When I started the business, every bank charged a point. If you came through me as a broker, the bank didn't charge the point, let the broker make the point. So it was a wash. And that's what the industry changes. So I don't know if it's about blaming. There's definitely speculation that people are saying all different things. You're gonna look at it that way. But I think, just simply put, is that while things are slow, they want to double check and cross every T. Let me get information directly from the borrower at this point.
Got it. Okay, so let's shift over to the technology. I guess the future of where you see the future going.
Present.
The present, yeah. So I wouldn't even know where to start with creating technology. So how's that experience been creating different technologies? How did you know how to do that?
So I'm not sitting there as a kid. I did a drop of programming, but that's not my real forte. I think really the way I view programming is taking a vision in a process, what you want to be automated or centralized, and then just specking it on a paper and hiring an expert in-house or a firm to put it out there. So I take, for example, after all the years of being as a mortgage broker, saying, hey, what are all the things tools that a broker uses, has access to provide information list of lenders, what's going on in the market, what's for sale, what's happening here, comps, notes, and we have a total recall of everything. And what would happen? We took that information and we made it client facing. So now a client has that same dashboard in front of them. They have the same calculator. People, for me, there's a fellow, when I came into business, he's a big senior underwriter today. His name is Matt Texler. He showed me, that's why I appreciate really what you do as a business. He showed me the spreadsheets that get put out on a retail deal, where they talk about for tenant improvement leasing commissions, and show that if you have a 5-year lease and over a 10-year loan, you have, and it starts today, you're gonna have to deal with 2 rollovers. So you have to put more TI cost in the underwriting. But if you took a 7-year loan, you only have to deal with it twice, but then the commissions are higher. And when a client calls up and says, "Oh, what about all these scenarios?" And I realize that this client thinks, "Wow, this broker's a genius," or "This underwriter's a genius," when really, just look, he just changed 2 or 3 numbers in a spreadsheet. So I always felt that, I'd rather play the game of chess. Let everyone have all the cards and everything in front of them, and then I want to win by who's going to be most trusted advisor, getting the right advice, have the best interest of the client in mind, and price things accordingly. So I built these tools that a client shouldn't feel like they're in the dark in an area. Well, wow, I don't know anything about this area. It's like, take my signature products and calculator. Someone could underwrite a deal in minutes. And I get a phone call from an underwriter. "Oh, I'm going to lose my job." I said, "If you're losing your job because of my calculator, you're not that good to begin with." My calculator is really just going to allow the person all the what if scenarios he can do it himself. It quickly, once you get to the NOI of a building, which is your expertise, all the assumptions afterward. But when you get down to the last 5%, think about like AI. When people use ChatGPT, you ask a lot of questions, but if you don't know how to do the last 5% yourself and edit it, something's gonna be wrong. You don't have the last 5%, you need that underwriter to go line by line, not just on a high level to get it done. So it's basically taking the tools in the business process, giving to the client in front of them to use it. And then as clients call up for different things, keep adding different features, different data sets to make it to enhance a little bit more.
So give me like a list of, you mentioned some of the items, but what are the other pain points that you've identified that are helpful for, let's say, brokers? Let's start off on the broker side, and then let's talk about like for people that are looking to purchase properties and stuff.
So on the broker side, they need the main. Everybody needs a calculator. We're map-based centric industry, right? We're doing properties throughout the country, so everybody needs some sort of map-centric place to be able to pin all the deals that were worked on and recall them. And sometimes you don't remember an address of a property or which broker sent it to you, but you remember you look on a deal in a certain neighborhood. Imagine being able to zoom down and see every deal you looked at. And once you go into that deal, have everything all in one place. So for a broker, it needs the same type of functionality. The broker needs the calculator, right? Max loan from debt service coverage. You can't know what's a debt yield. And if you make this change here, how's that going to play out? Percent of cost, all those numbers quickly, they need that information in front of them. Saying a lender needs the same tools. These same tools are for both sides of the equation. If you're a listing broker, then we allow you also to, hey, I'm selling a property, link yourself as a key player to a property and say, hey, I'm selling that property. On the other side of the equation, the owner needs those same tools. And the need is those same tools to see what's for sale, what's going on in the neighborhood, some comps, store the documents, total recall, the calculator the same way. And for everybody needs is rates and banking. So you could go onto the site and say, hey, what are the rates today? Now, again, I tell people that look at it to replace the first phone call to your broker, the first phone call to your lender. If you were underwriting a deal, Mark, and someone said, I want to do a deal in Texas with a local bank, or I want to do a shopping center, what are the rates there? You're going to have to stop you doing, make a bunch of phone calls to banks. Or if you're a brokerage firm, you have someone in the office. Provide that same tool. And that person in the office by me goes there every day, reviews the list. There's mistakes, we're human, but at least it's within a range enough for you to do back of the envelope, make those calculations. Which bank? Do a filter and say, hey, for this type of property, this type of loan amount, which are the lenders, that narrow down the lender list from there. So we have mortgage brokers who sign up also, listing brokers. They want to be able to sell the properties better. They want to know which lenders are active for the property, take a call. So all the tools that you need, holistically is put into one piece of technology, and it's set up for anyone to use. It's free to use. You want to have more access to it, pay $99 a month to max $500 a month. So it's the tools that someone needs to make the smarter way to acquire, underwrite, and finance commercial real estate, and then go off what they want. But I realized the key difference, and this is really where we speak all the time, and where I think that those that are in the underwriting space have huge opportunity right now, because I'm of a belief that technology will never replace the human. You may change the name of a broker to a funding coordinator to a processor to different names, but there'll always be a human involved in the commercial real estate transaction. There are other companies to the left of me who think technology has no role. To the right of me say technology is going to replace a human. I think there's always going to be that blend in the middle. And what's happening now in this environment, because transactions are down, many owners, any buyers have to let go of some of the staff, and they're compensating by utilizing technology more to fill some of the void. And then when they need that expertise, picking up the phone to underwriters and saying, hey, the gig economy, and saying, hey, could you underwrite this deal for me down to detail? I narrowed down 100 deals down to 20. I used GParency's calculator to get it down to 5, but I want to really get the due diligence and the underwriting on these 5, and they'll pay someone to do that work on those 5. So I think that there's more value that they're able to provide in that outsourced world of underwriting. That's why I'm a big believer that people coming into the space, there's 3 doors to come into. Going to get into real estate. There's property management. That's you're more hands-on that you want to do. If you're a numbers person, go through the underwriting door. Because the deal is only good as the financing. Learn the underwriting, learn those numbers. And the third door is come as a broker. And as a broker, you start in the space, you learn the business from all sides of the table, and then you move up from there. You wind up becoming that owner.
How are you? One of the things that I love is AI.
I love it.
And I don't think AI. I think AI makes you smarter because it opens your mind. It gives you more. It gives you like a superpower, and it once you realize how to use it, it makes you much. It gives you a lot. It's a power tool, an amazing tool. How are you using AI in your business?
So first of all, just to second, what you said, I think it's the biggest game changer. I think that what it allows someone that comes in new into the business to have a built-in, 100-year experience genius to ask all questions to. And like even you asking a question, it will like put blanks where you have to get answers. So at least you know what you should be focusing on to get what you're missing. And we have to realize that every one of the vendors is starting to use it on their side to make their world easier. So it's even less. And that's why I think it's also a little bit scary for, who's the most valuable? Is it the entry-level person? Is it the most experienced person can do more now because of it? Like that's that big debate. Definitely the people in the middle have no value. You're either at the entry level using the superpowers, you're at the top of the game, polishing everything and having and streamlining. But with the way we're using it now, is when we finish doing the calculations, it starts writing about the neighborhood, we're able to create your own OM in GParency. So the first phase is using AI. But we're going to be using it right now is we're going to be sharing the data that we have. It's our proprietary data on banking and on listings. We're soon able to ask it questions where I'm looking for a loan in this area for this type of property, and based on the loans that I did in the past, which loan do you recommend? So they'll have to give you more, they'll have to pick up more information and put it, make a much better experience of giving answers. We plan on doing for underwriting, get the lenders to tell us their underwriting modules and say, for this deal, who's the best lender? Not just which lender is lending in New York, multifamily, and these rates and these loan amounts, but also based on my underwriting, how I underwrite, which bank has the most similar underwriting to me, that'll give me the most proceeds. Or that they will consider this a conservative loan, and therefore that pricing will be better. And tie which buildings are for sale, and based on which buildings are for sale that I might want to buy, and know my banks that finance for me would finance those deals. So it's all about feeding the data. So what our competitive advantage now is we have the data on 150,000 listings, and we have the data on banks and what they're lending on an ongoing basis, and we want to be able to keep feeding this information. So we're now hiring brokers. We're paying 80% commission. We're training new brokers. It's putting it out here is that we have our sunk costs are done in the cost of core business. So to be able to hire brokers like an Uber brokerage, let them broker keep the lion's share, which they do the work, they should get it. But as they bring in business, our whole platform becomes better because we know more banks that are lending on what and what they said yes to, what they said no to, and that data is what we're hoping to be that source of the flywheel, because every deal needs finance. A deal is only good as the financing it gets. That's what I was taught when I came to the business. So the more data points I have in financing, the more feedback I can have, the more nuanced feedback. And that's why I want to have all suite of all properties. My goal is to touch every commercial financing in America, either because some just use our technology to know which bank to go to, or they want us to broker assist, like direct assist. They want to go direct, they need $4,500, or they want the full brokerage. So that using this data, and imagine how ChatGPT is only a year old. Imagine what's going to be another year from now, right? Imagine where all these AI companies that are all the vendors we use now, your underwriting companies, what they built, and your models, and it's so much easier to do different things. And just imagining where these things go. And my goal is to get them to all start talking to each other in a meaningful way, the way the owners and investors, while they're acquiring, underwriting, and financing real estate, they do business to make that experience much better.
Right, amazing. So you spoke about your calculator. It's a very, very interesting tool. It's a very good tool. Give it a little bit, talk a little bit about, give more detail on your calculator.
So what I found, most deals that went sour from people is that they didn't have the proper tools themselves to make the right assumptions for going forward. They knew, I'm going to hold the deal for about 7 years. I plan on selling at this cap rate. Rents will grow around this amount. But they weren't that sophisticated themselves to have Argus and all these different tools. They couldn't really get a holistic view from the time what the purchase price is down to the NOI. And then from that point on, of all the assumptions of where the rates are, where the growth rates, maybe there's 1 year they want to make a change in the year, how the IRR plays a role. What about the waterfall splits? Based on the splits, have a deal as a 25% IRR, but based on the splits, how's that going to play out for the LPs and the GPs? There was no holistic view. So I realized that everybody has a different way potentially. They say if you have 10 people, you have 12 opinions, that type of line. You meet people, how they get to the NOI, everyone has a way they do it. But once they arrive at the NOI, from that point to the end, it's all the same information. It's the same set of questions. What leverage do you think you're getting? What interest rate do you think you're getting? What is it? What rents are going to grow at what rate? Expenses are going to grow at what rate? All of those points, and what's the, to calculate the IRR, what are you going to sell the building for? All the information is pretty much everyone asks the same questions, but they don't have a good tool that holistically allows you in under 3 minutes to plug in these numbers and start playing with all the different assumptions. So someone says, what if this changes? Okay, I'll tell you what it looks like. Oh, that's not so bad. I'm fine with that. What if, like I was saying before, the example of with the leasing, the 5 years and the 7 year leases, what happens if instead I hold the deal for 10 years? Does that change? What happens if I actually do a supplemental in 2 years from now? First, I do a refi in 5 years from now. Those different equations, it's not like guessing what you think the math works to, because IRR is a complicated metric. It's not an average of a cash flow. It depends when you get the money back. You get more money back in the beginning, that's a higher IRR. You get the same amount of money back towards the end, it's a lower IRR. And all these things change. So we provide a tool in under 3 minutes, you can have it and then share with your partner. So I spoke to someone who says, I like to ask people why they use it, what the benefit is. They said, listen, I do my own NOI myself. So I plug it in, income expenses, tells me the cap rates, I can adjust the cap rate and I move to the end. But they say, what the benefit to me is that I either use it to help me, instead of me having to do a deep dive on the list out of 100 deals, I used to do a dive, spend 20 minutes to a few hours on 20 deals. Now I only do it on the 5 deals, but I spend a lot more time in it because through the calculator back at envelope, I realized these deals don't make sense. They use it for that, and they use it then for the last mile. When I send the deal back to an investor, back to a buyer, back to a partner, I start calling the million questions. What if? No problem, play it to what if yourself. Here, and I can send the link out to it. So that is what we built, and the next feature we're putting in is going to be more AI and the ability to upload all backup documentation. So it's like basically have an OI in one link, send it out, people could use it and share it. And it's a total free tool. There's no cost at all to use this tool. You could use it, share it, play with it, do what you want with it, and it saves it on your property the other side.
Right, amazing. So I want to open it up for some questions. So if anybody has any questions, feel free to add it to, there's a Q&A tab at the bottom. So we'll definitely open it up to some questions. Don't be shy.
We always get the not shy. There's only one person normally comes in.
Oh, here we go. Why would a broker work with you? It's a good question. By the way, I just want to say one thing that touch on something that you spoke about before. I can't tell you the amount of value that a good mortgage broker brings to the table, or a good advisor brings to the table. That 1% fee is, or that whatever the fee I feel is, if you have a good broker, that can really, really, really help you on your deal. It's well worth it. Okay.
Okay, so which questions do you want me to take? The first one, why did a broker work with me? So the answer is, I want to just talk about what you said. I believe 1,000% that there's a value in a broker. You want to call it a broker, intermediary, advisor, whatever you want to call them. Where I have my question is the transparency on the fee structure. How much should they get paid and for what deals? At times they're worth 3 points, and at times they didn't bring any value at all, and at times they just pay them for a couple of dollars to do some jumping from there. So that's where it goes. So why would a broker work with you? A broker is not a listing broker works with your parents because for free I'll help them sell the properties. But why a mortgage broker works with us, they want our banking data. So they pay a subscription. So they, hey, instead of having a whole team by their office, they could pay. So we have many brokers that are using the software. They're their advisor, and we're just another source that they get a data play for us. Regarding this to circulate, I guess, Mark will send it. It's easy. Go into gparency.com and you log in. All the tools are there. When you log into the marketplace, everything is there. I'll answer the other question. I'll go back to the once on the gparency product. What enhancement does the paid version have? The paid version gives two things. One is that when you're non-paid, you could have every time you open up a deal, it saves it. Like imagine Google Maps. Like gparency is looking to replace Google Maps. Right? We did a deal with Google with an incubator. There's Google at the bottom. Imagine all public data, listings, your information, all overlaid on the map. Imagine on Google Maps, you could put notes in. And every time you open up a property, you come back later, see a star hovering over it. That we allow you to have 25 deals in your pipeline at any one given moment. If you want to have more than 25 deals, that's the $99. So if you want to have more, if you want to delete your deals, replace them, it's totally fine. No issue at all. But the other main enhancement you get is that for $99, I'll tell you the top 5 banks to go to for each of your deals. And for the unlimited product, $500 a month, unlimited to your whole company and unlimited all the banks. So mortgage brokers that are using the software and big owners are using it on the $500 a month product, $495 to be exact, or $99. And that's what it is. But I think can you spend a few minutes on the webinar topic with a focus on finding opportunities these days? You want to start with that, Mark?
Yeah, I think I'm seeing in terms of in-place cash flow, in terms of deals that you're not relying on something that's going to happen in XYZ in the future. I'm seeing opportunities that I haven't seen in my career. It's interesting. It's like if you remember Bitcoin, people love buying at the top of the market when the hype. But now that and I don't know when the top or the bottom is, but in terms of seeing deals that have high cash flow, seems like there's opportunities. A lot of people are scared. Seems like there's some decent opportunities right now. But touching back on what you said, question is it like catching a falling knife? Are the values going to still go down? Is the rates still going to go up? So that's my thoughts. Ira, what's your thoughts on?
So I'm not sure if the way he was phrasing the question, I'll go to answer his question, flow into your answer, is that I think focusing on finding opportunities. So there's obviously there's the main sites that are known to be listing sites for commercials, a lot of fragmented, but you have LoopNet, CoStar is number 1, Crexy is probably number 2. I think gparency is number 3, holding like 150,000 properties. I think they have 200,000, a little more than 200,000. The commercial universe of properties for sales, not in the millions, a few 100,000. So my recommendation that I found is, and tying into what Mark is saying, is that in this world, I found the most successful people don't rely on the backup data of other people. They trust and verify. They do it themselves. So that's what the big push gparency difference is. My goal in gparency is to solve for the first mile. Come here, look at a property and realize, hey, there's a building next door for sale. Hey, give me an alert when something pops up for sale in the neighborhood. That information is, I'll tell you the guy's name and phone number, the broker, he or she, and call them. So my advice to you now is target a neighborhood you want to buy in. When you go to that neighborhood, go whether it's through gparency or these other sites, find out which brokers are active in the neighborhood, start building a rapport with them, see what they think is happening in that neighborhood. And as you start realizing that things are leveling, the knife is stopping to fall in a certain neighborhood. It's possible the knife is falling in one part of the country or one neighborhood and not in a different. But the minute it looks like it stopped, and at this point, you can get good opportunities. And then you'll place it there. That's the idea of the gparency business model, is to help you. Why in the acquisition mode? Keep all the notes of everyone you spoke to them, recall on a map, because that's information. That's how I guess getting a deal. Once you think a deal makes sense, if you're new, this is where the Mark's business comes in. Because once you think you have a deal, you're calling up Mark and saying, Mark, I'm thinking about this deal. Spoken deal looks good. Can you help me with the numbers? And there's other companies and people, and this is what they do. There's that due diligence and underwriting that they do. And now you could say, okay, you don't want to spend any money to back an envelope. That's transparency. You might want to bring someone in and say, hey, I have a friend of mine who do a little bit better for me. Give me a template and do it in a spreadsheet, or take, Mark keeps giving amazing underwriting courses. You take those courses, you do more yourself. But then this way, when you need that expert, you're using that expert in a deal that you're taking very serious. You know it's the right deal, but you want to make sure it's the best money to spend, because you're about to go forward and buy a deal. And Mark calls you and says, hey, buddy, I think you overlooked this detail. And that little information saves your whole life on the whole entire deal. That's where the real value of an amazing underwriter is able to be there. Mark, I think if we go to on the next question, can you elaborate on the breakdown how the 1% of brokers' commission gets divided? So I want to take the word, let's get rid of the word 1%, whatever the commission you pay, right? I don't think 1% is the industry starting point, but let's turn it instead to $1. That money that you pay as a brokerage commission on a commercial or multifamily property, that money goes to the brokerage shop and the team. Typically, rule of thumb, it's about half goes to the house and half goes to the broker and all the people that worked on the team. They split it. And that's where, like on the transparency front now, if the market's slow, we're hiring and paying 80% commission. I believe that if you're already going to be using a broker, it's not the firm you're using. No one uses blank firm. They go into that specific broker. And that broker and his team or her team should be getting the market share, the 80%. That goes to them. However they split it, it's their money. The lender behind the scenes sells the deal to Fannie Mae and Freddie Mac. It has nothing to do with this part of the equation. Sometimes when that lender sells it, do they have a correspondent or relationship with the brokerage house and agrees to do some splits, yield spread, different terms? That's on a deal by deal situation basis. But right now, what the changes going on in Fannie and Freddie have nothing to do with any of the fee structure that we're discussing over here. It's not being discussed at all. Mark, there's a question for you on the chat. Okay, what do you decide to what do you decide to capitalize as opposed to expenses for repairs and maintenance during due diligence process? You typically ask for a balance sheet.
So I mean, there's a few ways. I think what you're asking about is when you have repairs and maintenance, there's ongoing regular repairs and maintenance that you need to operate the property. A shower breaks, a window breaks, something these things come up. So there's a typical budget that you'll use for operating regular repairs and maintenance for operating. Then there's additional type of I guess expenses. It's capital expenditures. Like you want to renovate a kitchen, or you need to replace roofs. So I don't think there's really a right or wrong way to structure it. You can come up with a budget at closing and decide, okay, we're going to raise we want to do $1 million of work to this property. So you could take that full million, you can raise all that money up front. Or you can say, look, our deal should cash flow very nicely. We can pull some of that money out of cash flow. So it really this goes into how you want to underwrite the deal, and how do you want to back into the returns that you're looking for. Because a lot of times, if you take that money up front, if you capitalize money up front, as opposed to taking out from cash flow, it could result in a higher IRR, or it might result in a lower IRR. So you really have to run the scenarios to try to understand what's the best way to.
Can I interject here on 2 points?
Sure.
One is that this is a great live example of where the calculator comes in. Most spreadsheets require you to fill out the whole spreadsheet in order to use their IRR calculation. Over here, you can simply put in the overall expenses, put in the capex, see what the IRR works at, and now change it. Pull out that capex, change the NOI, and then see how it plays a role. Those two differences. That's the example. But I want to really bring up this point that you're discussing. This is what I think is also going to change for standardizing of underwriting. I think that Freddie Mac said you could do this, like interest only. When interest only first came out, they didn't let you have interest only affect your loan amount. They underwrote a deal based on a 30-year amortization, and then what's your debt service coverage? Interest only happens to give you interest only, so actually you have more cash flow for yourself the first year. Now it came to a point that, oh, there's a 130 debt service coverage, let's say. Oh, during the IO period, give me a 130 coverage. That's what changed. I think some of these things they're going to relook at. The fact that you're taking an item and putting it up front and then say, hey, my cash flow is better, I think that's an issue they're going to take from there. You wanted to see this here. How do you track the lender and broker after making the match? Do they go offline? Not that I would, but others technically might go directly to the lender again without telling you. Is that a concern? So that is a concern for the typical commercial mortgage broker, right? That's they want to make sure they protect it, not going behind their back. On GParency's business model is that there's no restriction. If I'm really, GParency views itself as GP. I work for the GP. You pay me a fee, whatever I have is access to you. If you use the core software and placement product for $4,500. And in that case, that's why people like it also. Start here. It's your data. Do what you want with it. Some people use us and then they go to the broker and they leverage it to get themselves a better deal. It's up to you, however you want it. I'm not your partner. You're not my partner. I'm providing you value. I work for you, and that's it. Who makes the most money in the chain? Is it the lender who sells to Fannie and Freddie? So I don't really know the answer to the question. I just know also there's a liability issue, right? A mortgage broker, unless there's fraud, makes the money the deal closes. Whatever commission they make, they keep. A lender has a participation agreement. If the loan goes sour, that lender and Fannie, even if they're making more money up front, they have a risk share in that case. So I'm not really sure you look at it as Fannie making the most money. Listen, Fannie, it's a complicated conversation based on risk, reward, and overhead, and all these different types of things to look at. But that's just the concept of how this works. What are the different ways people can help GParency? I'm not really understanding the question that way. Becoming a client, that's a help GParency. And there are clients who also come in, and while they're using the site, they share and give feedback and say, hey, I noticed the mistake here. So we make the site much better as a community working together to get the best data that the industry can have.
All right, I think that's going to wrap it up. So thank you very much for joining us. Thank you all for joining. And just to touch on one more point, in about 2 weeks, we're going to be launching a beginner's course where we're going to, for anybody that's looking to get into the business or to really just brush up on some of the technical parts of the business, we're going to be offering a great course. So look out for that. So Ira, thank you again for joining us. And
thank you so much.
well,
Best of luck. Thank you so much.
All right, take care.